You're listening to Beyond the Box, Unlocking Creative Mortgage Solutions. I'm your host and guide, Brett Clark. We're going for smarter strategies, creative financing, and solutions that get deals done. Whether you're a realtor, loan officer, or investor, it's time to think big, act bold, and close more deals. Let's dive in. Welcome to another episode of Beyond the Box, and welcome back. We are unlocking creative mortgage solutions, and today we're diving into a special episode all about answering your most pressing questions on non-QM loans. So whether you're the realtor, the loan officer, or the investor, this episode has something specific for you that we're going to cover, talking about essentials, tackling common challenges, and sharing tips to help you thrive in the creative financing world. It's packed with value. Don't miss a second. So before we jump in, make sure that you get this podcast out to your friends or your colleagues. Hit subscribe wherever you are. This isn't one you want to miss. Okay, I got the hype up. So what exactly is the non-QM loans? We're going to start at the basics. And if you haven't had a chance to pick up my book in Amazon, The Non-QM Edge, The Realtor's Guide for Closing More Deals, we're going to go more in depth with this specific topic, but it is what exactly is non-QM loans. So let's break it down. Non-QM stands for non-qualified mortgage. It's a type of loan designated for borrowers who don't fit the specific criteria of conventional loans or those backed by Fannie Mae, Freddie Mac, FHA, the VA, any of those type of bodies. These loans are for people with unique financial situations, whether they're self-employed, contractors 1099, recently went from salaried to self-employed, or just people with alternative income streams. Other people might be high debt to income ratios, investors, or high net worth individuals. Non-QM loans aren't about fitting into a box. They're about finding the right solution for you or your client's specific needs. Think of it this way. A non-QM loan doesn't ask, do you meet every guideline? It asks, can you repay the loan? And that's the game changer for one of those things that we've always been seeking for into the industry, of that no-nonsense concept of how can you repay it and how can we prove that you actually want the house, instead of do you meet all these strict guidelines. I also think that gets you to the beginning of the next question: how is a non-QM loan different from a traditional mortgage? And that is a phenomenal question. Non-QM loans differ from traditional mortgages in a few key ways. Traditional mortgages, like those backed by Fannie Mae and Freddie Mac, follow strict guidelines that are set by those entities, and things like income verifications, verifications of employment, credit scores, and debt to income ratios make them very predictable, but they're also for the predictable borrower or the predictable buyer. As we know, not all buyers are predictable. And that's where non-QMs are on that built for flexibility setting. They allow for alternative forms of documentation, bank statements, asset utilization, or just using the property itself to qualify for itself. This is allowing for higher debt to income ratios, unconventional income, or some of your new things that you're seeing like gig workers or influencers that are now of high net worth but don't have that consistency in the past to be able to show they can pay for the future. This is one of those places where non-QM gets to be outside of the box. In short, non-QM loans open the door for clients with unique financial situations, and people who may not check every conventional box can still get the house. Now, on the flip side, there are some people that do fit the conventional checkbox but still choose a non-QM loan instead. And why would that be? So non-QM loans can be a smarter choice for a variety of options. For starters, they offer unparalleled flexibility for borrowers with unique financial situations. Think about self-employed individuals or investors that have unconventional income streams or several businesses that they own, and those are all going to have their own S-Corps, C-Corps, their different K-1s, and that can get really messy really quick. And this is one of those places where even a conventional borrower might want the ease and flexibility of the non-QM loan. So whether it's the ability to leverage alternate documentation or bypassing rigid guidelines to secure better pricing for investments, non-QM are usually those tailored solutions that are truly helping our clients achieve their financial goals. And lastly, in this category, the big concern that I feel like a lot of people have, are non-QM loans risky? That's a common misconception that is built off of subprime in the past. Non-QM loans are not subprime loans. And let's get that right out of the back. This is not a subprime risky product. They're designed for those that really want something that is more tailored to them and their unique situation. So here's one of the big key differences. Non-QM loans do still have strong underwriting standards. Lenders assess the borrower's ability to repay the ATR using alternative documentation, not no documentation like subprime. The use of bank statements or asset utilization don't over-compromise their financial capability to actually buy a house. And that's where subprime was in the back. They were these risky situations with negative amortization or balloon payments, or had no true repayment strategy. That is not the non-QM world. In fact, non-QM borrowers have excellent credit scores, substantial assets, and just don't simply qualify under traditional guidelines. So far from being risky, non-QM loans are actually a powerful tool to help creditworthy clients access the financing that they truly deserve. All right. Let's make it a little bit softer now and get down to some of those things that you probably think inside your head. Well, what's the minimum credit score for these type of things? Now, that really depends on the specific lender of that non-QM product because they're all different with different investors. But generally, credit scores can go as low as 600, but will require other things like higher equity positions. And so you can get somebody into a 600 credit score with other compensating factors like assets, higher down payments, or something like that. Most non-QM loans cater to borrowers with mid to high credits, so often a 660 or above is something that you're actually going to see. And on the other side of that, now something else that might be on your brain is, can non-QM loans be used for primary homes, or are they just investment products? And that is a great question. Non-QM loans are so incredibly versatile that they can be used for primary residence, second homes, and investment properties. For example, self-employed individual might need a non-QM loan to purchase their dream house as they've gone from being a doctor in a hospital to owning their own practice, while an investor might leverage DSCR loans for expanding their portfolio. This flexibility is what makes the entirety of the non-QM loan a game changer in today's market because there is so much flexibility there. Okay, the next question. Who are these loans best suited for? The non-QM loans are tailor-made for clients who have unique financial situations that don't fit the mold, like we've talked about. And I think the people that don't get the most credit that this is perfect for are your new influencers, your movements from W-2 to now 1099 or owning your own practice, and your gig workers. It's not a traditional way of life, but they do have that stable income that's going through. Another place that is really good is foreign nationals and ITIN borrowers. People that don't have that same U.S. citizenship, but do have the financial capability to be able to be prime candidates for home ownership here in the United States. So ultimately, the loans are designed for anybody that is financially solid and can meet, normal ability to repay requirements, but don't necessarily fit or want to fit into those very, very strict, sometimes annoying guidelines inside the conventional sphere. And now let's break it down to some of the questions that might relate directly to you. For the realtor, how can I educate my clients on non-QM loans? The best way to educate your clients is by breaking it down in simple terms. Explain the non-QM loans and how they're designed to fit someone that doesn't fit into that normal traditional mold. Your self-employed individuals, investors, and other unique income situations. Using real-life success stories from those of us that have been in the industry can also help you find those different ways to solve the problem. And this is one of those places to help educate them. And if you don't know where to get started, reach out to us because we're always happy to share our stories with you. For the loan officers, what documentation do I need to provide? And that documentation for non-QM loans is often more flexible than traditional loans. Depending on the product, you might just need bank statements or assets or proof of rental income rather than getting standard tax forms, your pay stubs, and W-2s. So it's really going to depend on which program you're using, but generally speaking, it is less documentation than you're used to using in a jumbo or conventional space. And for the investor, how do non-QM loans help me grow my business? Non-QM loans can be a game changer for your business, whether it's realtors expanding your buyer pool, or loan officers trying to find more solutions, or even the investor that is trying to build their portfolio and has already financed 10 properties. As we know, Fannie Mae and Freddie Mac, regardless of your credit worthiness, will no longer allow you to finance any more properties, where there's no limit to what you can actually get into with different investors inside the non-QM space. All right, I hope that was beneficial for all the different ways that you can look at different questions and maybe some of the questions that have been on your mind. So I want to thank you for tuning into the special facts episode. We've covered a lot. There's even some stuff that I probably wanted to stick in here and couldn't get to, but there's always more to learn and explore in the world of creative financing. So if you have any questions about non-QM loans, unique client scenarios, or anything we discussed today, please comment down below, subscribe, or reach out to me. I would love to get more facts episodes out there to you. And don't forget, I'm now on YouTube. So check out the channel for more tips, insights, and even videos, video content coming soon. Subscribe, share, and join me there to keep your momentum going through 2025. I'll also be hosting some interviews coming out on branding, business building, a realtor that became a builder, and a loan officer that became a realtor, looking at those success strategies in both the long and short formats. So stay tuned for even more valuable content. Let's make 2025 the year of growth, one day at a time. See you next episode.